Hello traders, this video is about the force index. What is the force index? Okay, and for those of you who are new to us, we are the TSTWSYS 008 traders, and our website is www.stochastic-macd.com. And for all trade, we use the 5% money management rules and apply stop loss in all trade. This video is for educational purposes only. It is neither a solicitation or an offer to buy or sell any financial instrument. It is primarily for the TSTW SYS 008 traders. Okay. What is the force index? The force index is one of the best indicator, okay, created by Dr. Alexander Elder, okay, and the calculation for the force index is about the closing price of today minus the closing price of yesterday multiplied by the volume. So closing price of today minus the closing price of yesterday multiplied by the volume, okay, is one of the indicators that is combining the price and the volume, okay. Now the idea behind this indicator is that when the price is rising, the price when a bullish momentum okay has started, okay, for that bullish momentum to be a healthy momentum, so to speak, it must be accompanied by a high volume. So we want to see the price going up and also the volume rising. On the other hand, if the price going down, we want to see the price going down on high volume, okay. So that's why the calculation is about if today's the closing price of today is lower than the closing price of yesterday, the force index will be negative, okay. And when today's price, the closing price of today is higher than the closing price of yesterday, okay, the force index okay will be will be positive, so to speak, okay. It will be positive, meaning that it's above the zero line. The zero line is the yellow horizontal line here, okay. So this is about the force index, okay. There are three components for the force index. The force index okay, is trying to reveal to traders the direction of the price, okay. So when the price going up, the price must display higher lows and higher highs, okay. So by calculating today close minus okay yesterday close, if the price going up, okay, we'll have okay a positive result. On the other hand, if the price going down, okay, the closing price of today will be lower than the closing price of yesterday, meaning that the bear are controlling the market. This is just about the definition of the uptrend and the downtrend, because in the uptrend the price must display lower higher lows and higher highs, okay, meaning that the bulls okay are controlling okay the market. So when we see the price displaying higher lows and higher highs, it's telling us that the bulls okay are in charge of the market. The price will continue the movement to the upside. That's why when okay the price fails to display a new higher high, we must be very careful, okay. We cannot take any more a bullish signal, okay, until further notice. On the other hand, if the price going down, okay, the price must display lower lows and lower highs until the price fail to display a new okay a lower low, okay. So when the price continues to display a new lower low, we know that the bearish momentum continues, which means the bearish force is superior. What you have to understand, what the intention or the purpose of the force index is to reveal to traders, okay, the group that is controlling the market, either the bear or the bull, okay. But if you are using the force index because it's just because the force index is below the zero line, okay, you are just selling because it's below the zero line, you are likely to make a lot of mistakes. As you can see, it's all over the places, this force index, okay. But as you can see, if the force index is below the zero line, okay, and the price give a rally, so we want is below the zero line, telling us that the bear are in charge of the market. Now if the price rally up, that's an indication, okay, an invitation for trader to sell, okay. But if the price okay, but we will receive the signal from the price itself, the number one indicator, not from the force index, okay. Another thing that traders are doing is that they will, you can see the turquoise line, which is, you see this one here. This is the turquoise line talking about the force index, okay? The turquoise line here, this is the force index. The red one here is the exponential moving average 2 of the force index. The white one here is the exponential moving average 13 of the force index. Some traders will place a trade to buy when, okay, the exponential moving average 2 of the force index is below the 0 line, okay, and they will sell when the exponential moving average 2 of the force index is above the 0 line, okay. Another understanding of the force index, that some traders, they will use the exponential moving at 13 of the force index. So when the exponential moving at 13 of the force index is above the 0.9, it's telling that the bullish momentum will continue. Now, as I explained to traders, we are not trading indicator. If you get into that kind of a trading mode, you are likely to make a lot of wrong mistakes, okay? Because you can see here that the red one, which is below the 0 line, but the price, okay, gap up here, okay? So how can one trade the force index? The force index, I mean, one can perfectly draw a trend line, and one can perfectly know exactly what is taking place in the market. For instance, here I will draw a trend line here. Moment please. I will remove this one into another one. I will erase that, okay? Moment please, I'll get there soon. So we draw our trend line on the chart that will give us a clear indication better than the force index, okay? Now if the bulls are controlling the market, the price might display higher lows and higher high. It's just simple, okay? We do not have to consult the force index before we know. But I'm not saying that the force index is a useless indicator. I'm saying that one can perfectly, okay, understand the price itself, paying attention to the price itself, okay? Now as you can see here, the force index was above the 0 line, telling us the bullish momentum will continue, and suddenly it went below the 0 line. We are on the 4-hour chart of Apple stock. This is on the 4-hour chart. It did below the 0 line here, okay? In some traders may say that it's bearish, but look what's happened, okay? The price gap up here. Now when this is a distortion here, because the price gap up and the indicator couldn't catch up with the price. In fact, it just went down. You see, and the price pulled back near the trend line where a lot of bulls are waiting to buy, and the force index was still below the 0 line but was rising. So it's up to you how you want to look at it, because it's just telling us, okay, whether the market is bearish or the market is bullish, whether the bulls are in charge of the market or the bears are in charge of the market. Some traders will use the divergence, okay, of the exponential moving at 13 of the force index, okay, to make a decision, okay. So when they see the exponential 13 of the force index displaying higher low, but the price displaying a lower a higher low, but the price display lower low, they will take a bullish position. On the other hand, for the bearish divergence, when the exponential 13 of the force index display a lower high and the price displaying higher high, some trader will look for opportunity to sell. But as I explained to you, drawing the trend line on the chart itself, the #1 indicator, one can perfectly make a better decision. Some traders, they will place the exponential moving at 13 on their chart, which is this one, the orange one here, and any dip of the exponential moving average 2 of the force index to the downside, when it starts turning around, some trader will take a trade. But I'm telling you that you can perfectly trade without the force index, okay? But I'm explaining to you the components of the force index. It's about the direction of the price, the extent the extent to which the price has changed, okay, and also the trading volume, okay. It's one of the indicators that is combining, okay, the price, okay, and the volume. And the calculation is about the closing price today minus the closing price of yesterday multiplied by the volume. It's trying to measure the strength of the bulls and the bear. And the idea behind it is that price going down, the price should go up. When the bullish momentum is increasing, it should be backed by higher volume. And if the bearish momentum is increasing, it should be backed by, okay, a higher volume too, okay. So I will be posting another video very soon, and I'll explain a few things to you, comparing the price itself and the force index, okay. Thank you for watching, and we will speak to you very soon. We are the TSTW SYS08 traders.